Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. And today we want to shine the spotlight on the first week of the reporting season. Paul, let's kick off with the CBA.
Yeah, let's have a look at the Commonwealth Bank's result, Peter. Cash NPAT, or net profit after tax, down 1.9% to 4.74 billion. Now that included a provision of $375 million for a potential fine from Austrac for the anti-money laundering. Yeah. They don't really know what it's going to be.
It's the real cost of controversy, isn't it?
It's a cost of controversy. So adjusting for that underlying cash NPAT of up 5.8% to $5.11 billion. Look, capital ratio strong at 10.4%, leverage ratio above target at 5.4%. And for shareholders, the dividend up 1 cent to the interim dividend to $2 per share.
Okay, let's go to the positives from this report, Paul.
Look, the main positive was what we call positive jaws. That's where operating income grows faster than operating expenses. 4.9% for income, 4.7% for expenses. Now, in that 4.7% expense increase, this is half year on half year for corresponding period, that also included another $200 provision for the cost of ongoing compliance work, their program costs. $200 million for their compliance costs. So actual business unit costs are only up 2% compared to the corresponding period. So that was quite strong. Look, loan impairment costs, they were flat, unchanged. And then I think the big one was the net interest margin. So it's showing that the pricing power that the bank has, and largely from repricing part of its home loan book, up 6 basis points to 216 basis points, and strong profit growth in most divisions, including particularly the retail bank.
Let's go to the negatives now.
Look, the main negative was a lack of volume growth, and I think this is a big issue facing all banks, but in CBA's case, it actually lost market share in both home loans and business lending, and that's a negative. The performance of their institutional bank, that was down half on half. Dividend was less than some market commentators had forecast. Some were looking as high as $2.06 a share, so $2 was a little on the low side. And this is just the ongoing compliance costs, Peter. Not only is this $200 million provision, but they also said that over the last 5.5 years, they've spent something like $4 billion on compliance costs. God. These costs aren't going away in the short term, and that's a bit of an issue, perhaps more so that CBA is facing than some of its competitors.
Yeah, that's huge. Now, the overall assessment.
Look, I thought it was a robust result. Look, it's like it's a 7 out of 10 result. Look, obviously it shows what's going on with banking. Look, bad debts really are under control. There's no pressure on margins at the moment. There is some revenue growth coming in, and there's some cost growth. So I think banks, and particularly the Commonwealth banks, to look reasonably attractive.
Yeah, so you and I both like banks for this year as a contrarian play. Nothing in this has turned you off.
Killed a little of the market. There's nothing in that result that changed my position that banks don't look like good value.
Okay, let's now go to Rio, Paul.
Okay, let's start with Rio. Underlying EBITDA up 64% to $18.6 billion. They report in US dollars, and this is a full-year result from Rio. Net earnings are $8.8 billion, up 90%. Earnings per share of 490 US cents per share, so that was up 91%. Good positive was net debt was down to just 3.8 billion US dollars. And for shareholders, a full-year dividend of 290 US cents. The final's 180 US cents versus 125 cents in 2016. In Australian dollars, that's about 200, and the final dividend's about 228.6 Australian cents. Just a quick one on the composition of the earnings. You can see there on the graph in front of you that pretty well all of the 4 major divisions contributed, about 60% of the earnings coming out of the iron ore division.
But that dividend's like a nice make-up for the punishment shareholders received a few years ago.
Yeah, it is, Peter. And look, I think shareholders will be happy with that outcome.
Okay, let's go and look at the earnings increase due to price.
Yeah, I think it's really important to point out why is Rio and why these major resource companies are done so well. And as this is their own data, own graph, which shows you that really the earnings increase is almost solely down to the underlying price changes in the commodities. So a really big increase due to price. Now there's some positives in that. The positive is they've kept costs under control.
Yep.
And we all know there's been some cost pressures, particularly around some of their raw material costs. But they actually haven't been able to do a lot on the volume side. I think that's probably one of the negatives that graph also highlights.
But I guess the prices are also reflecting that this global economic recovery is helping the miners.
Yeah, it sure is. And we've got all economies, growth across all major economies. We've got in particular places like China, very focused now on some of the greener outcomes and worried about pollution more. And that's actually benefiting producers like Rio, where the high grade iron ore is actually assisting with some of the targets that the Chinese government's introducing.
Let's go to the positives.
Okay, so I think the main one was the spin-off of cash for shareholders, $8.2 billion paid out to shareholders. Look, they've got a reasonably strong development pipeline with the Oyu Tolgoi copper mine in Mongolia set to come on in 2021.
Nicely pronounced too, Paul.
Yeah, and the Amrun bauxite development up in northern Australia. They then also announced an additional shareholder buyback of $1 billion US of shares. That'll be through the Rio Tinto PLC shares listed on the London Stock Exchange. On the cost side, they've completed their $2 billion cost out program. That's been completed a little bit ahead of schedule. And they're now focused on what they call mine to market productivity. So this is not dealing with the cost of mining. This is actually the cost of how you get it from the mining state to market. And things like driverless trains and all those other things to do with and the loading and the costs involved there. They're targeting something like an additional $1.5 billion annual savings by 2021 by looking at mine to market costs.
Okay, let's go to the negatives now.
Well, I mentioned some of those already. Volumes are largely flat, so they met guidance in volume production, but they haven't really done much to increase production. Cost savings, as we know, are becoming harder, Peter. They've done a lot of work around the mining costs as they're now moving on this mine to market. And then the EPS and dividend largely met forecasts, but there were some analysts looking for just a little bit higher. But I think the market's going to say that's a pretty good result.
Okay, let's do an overall assessment. Should shareholders keep on going to Rio?
I think you stay with Rio. I think the result, they had nothing dumb in terms of that shareholders aren't going to like the market or like that result. It's still largely a bet on growth and what happens to commodity prices, but at the moment they're still staying in uptrend. So I think people are going to be pretty happy with the Rio result.
Okay, so a pretty nice start to the first week of reporting season. I'm Peter Switzer. That's Switzer Investing Insights brought to you by NAB Trade. Thanks for joining us.